This is Market Day. Thanks so much for joining us. Our guest host today, David Manshey from Belvedere Share Managers. And got a bit of economic data out today. The Australian dollar getting a boost after trade data came in slightly better than expected. The trade deficit came in at $284 million in September. That's compared to $815 million in August. Imports down 1%, exports unchanged. Analysts, had been expecting a deficit of between $500 and $600 million. And let's get some perspective on those figures with Ryan Felsman. He's joining us from Colonial First State Management. Ryan, good afternoon to you. Thanks for coming in.
Hi Nadine, how are you?
Good, thank you. We've seen this trade deficit improving, but the reality is that we've seen 21 consecutive months in deficit. So just give us the quality of this result today. Give us some perspective.
Well, I think in terms of the actual current account deficit itself, around 2.5% of GDP, 3% of GDP, so 2.5 billion. That's certainly below the long run average. So what we saw in September was an improvement. So as you mentioned, the deficit fell from a revised 693 million in August to 284 million in September. That was largely driven by an increase in export volumes over the month. So export volumes are now at about 15% year on year. So that's the fastest pace in about 2 years. And what we've seen is resources continue to drive the improvement in the trade deficit position. So what we've seen over the course of the last 12 months is resources contributing to the improvement of around 20%. And that's largely due to the fact that we've seen iron ore prices rise. Iron ore exports increased by 5% during the month. So generally driven by the trade surplus in China. So we've seen in Port Hedland increases in export volumes to China there. So there's been a 33% uplift in those volumes in particular. And that's largely been driven by the improvement in Chinese economic data in particular. We've seen GDP growth in China of around 7.8%. So in terms of what we've seen recently, certainly growth in China has remained fairly buoyant, driven largely by continued infrastructure investment. There's still steel intensity demand. The iron ore price is around $137 per metric tonne, and that's certainly supported Australia's trade positioning as a consequence. Furthermore, we've also seen an improvement in the services component of the trade numbers. So services now are up about 8.3% year on year, and that improvement's provided quite an optimistic outcome for the tourism industry in particular. Certainly we've seen overseas tourist arrivals in Australia increase by in the vicinity of 5% to 6% over the course of the last 12 months. So in terms of the rebalancing of growth to non-mining sectors, that's a positive outcome as well.
All right, it's interesting because when you talk about that, it's basically, to summarize, we've not gone from mining boom to bust. And also just highlighting, the continued importance of China. I think trade surplus with China hitting a record high to $40 billion in the year to September. We've got this third plenary session coming up with China. It begins this weekend. Do you expect China to be able to continue this rate of growth? Do you expect it to continue to spell great things for Australia?
We think so. Premier Li came out last night and basically said that Chinese growth in terms of an absolute number will be around low 7%. He mentioned a number of 7.2% as a floor in terms of providing employment growth in China. So with growth still reasonably strong in China, around that 7 to 8% mark, certainly with infrastructure and urbanisation continuing to drive their growth, we expect that net export contribution to GDP to continue going forward. In terms of the actual policy announcements at the plenum next week, we expect some announcements around fiscal reforms, possibly some financial market liberalisation around short-term interest rates and the like. But there may even be some talk about relaxing the one-child policy in China. But certainly, we wait and see what happens in terms of where the direction of the party goes from here.
I guess one of the big events, obviously, this week was yesterday getting that, the Reserve Bank of Australia, I was going to say no move from the Reserve Bank, but leaving rates on hold at a record low. Anything that you see in the trade data, what are you expecting for unemployment tomorrow that could sort of change that picture going forward? Are you like Goldman Sachs, Philip Moffitt calling for more cuts in the time to come, related obviously to the Australian dollar, or do you think that we're sort of at the end of the easing cycle?
We think that the RBA will be on hold until at least the third quarter of next year. The reason for that is, as you saw today, Chinese data still remains buoyant. In terms of the domestic data, we saw retail sales pick up earlier this week, so we've had 5 consecutive months of retail sales growth. Retail sales are up about 3% year on year. So certainly also with the trade data, we saw the consumption side in terms of import volumes. They actually fell by 3% for the month, but overall over the course of last year, consumption in terms of import volumes have actually increased by about 12.5% over the year. So Australians with the elevated Australian dollar are still purchasing goods and services overseas. At the same time, we're also seeing a bit of a domestic pickup in retail sales. So generally speaking, you know, in terms of the domestic data, we're seeing an improvement there. But obviously, the key concern for the RBA, apart from rising house prices, as I've discussed at length, of course, is the unemployment data. The RBA's forecasting unemployment to rise to about 6.25% next year.
Do you see that happening?
We think that unemployment may have peaked around 5.8% thereabouts, but certainly we're looking for a pickup in business capex to support the rebalancing growth from mining to non-mining in particular. So markets are expecting a slight upturn, or uptick I should say, in the unemployment rate to 5.7% tomorrow, with job creation of around 10,000, but that largely is predicated on the participation rate remaining fairly benign. So certainly we think that the labour market still remains reasonably weak, but in terms of domestic data and certainly offshore data, you know, there's certainly been an improvement over the course of the last few months. In terms of the Australian dollar, we saw, as you mentioned, Governor Stevens jawbone the dollar down yesterday. It's part of his rhetoric around the Australian dollar being uncomfortably elevated around 95. He's not particularly comfortable with that. As a consequence, you know, the trade data today then pushed the Aussie dollar back up over 95, and therefore we see support for the Australian dollar remaining there in place until, I guess, the Fed seeks to taper, so reduce its asset purchase program probably at the beginning of next year, possibly December, if not January, if we see an improvement of payrolls on Friday for starters, and maybe the third quarter GDP number, which is released at the end of the week as well in the US.
Yeah, but Ryan, it would have to be a pretty dramatic read on unemployment to bring forward to December, wouldn't it?
Well, the benchmark for tapering from the Fed is actually 7%. We're currently at 7.2%. I guess with the government shutdown occurring, there's an expectation that unemployment in terms of the rate itself may increase slightly to 7.3%. In terms of the latest numbers, but we're seeing signs of an emergence of a services-led recovery in terms of the PMIs that have been released over the course of the last couple of weeks. Have both been strong. Certainly outside of the public service, you know, the data doesn't seem to have been too adversely affected, and with mortgage rates coming down to around 4.1%, the 30-year fixed mortgage rate, that should support the housing market in particular going forward in terms of activity. So we expect that activity to pick up again. We expect the postponement in consumer spending caused by the government shutdown to pick up into the fourth quarter, and certainly the fiscal drag that's occurred in the US in early 2014 should subside.
Okay, Ryan, we could keep talking forever about this stuff, but we've got to let you go. Thanks so much for joining us today.